Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, September 20th, 4:53 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. Check over here the trend gauge. You can see we've got all three time frames upon which we track the five major indexes. They're all trending below their short-term 21-day exponential moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. We do have some leading stocks holding up pretty well, about 12 to 15 stocks, so we're still stuck on neutral with leaders. If they break down, I would expect the market to go much lower, but right now they're holding up pretty well. So what happened today? Bidirectional false moves with the FOMC coming tomorrow. We had the market trended today, but it trended down, then up, then down, then up. False breakout, false breakdown, trying to suck bears in and trying to suck bulls in and trying to burn everybody. And we'll take a look at that on the charts momentarily. But the end result, well, the beginning result was about a 0.9% gap down. Then we went to green on the NASDAQ 100, but then we ended up fading again into the mid to late afternoon before a bounce. But the final numbers are all red. G6, this is our 6 ETF growth composite, down 1.66%, S&P down 1.1, NASDAQ 100 down 0.8, Dow down 1% today, mid-caps down 1.65, Russell down 1.4, Global Diversified 60/40 stock and bond down 0.95. Our in-house flagship GROTECTION down approximately 0.2%. We took a couple of positions today. I'll show you why, and I'll show you what the result of that was. But first, let's get into the charts and why we do what we do here at Revere. We'll also go through the tail of the tape, of course, as always. So let me bring in a chart of the S&P 500 and explain our trend following approach. A lot of people, especially there are some pie chart. What is a pie chart advisor? You hear me that all the time. This is a person who will stick you in a certain percent of large stocks, small stocks, international stocks, emerging market, and bonds, and just not sell. Just think that the diversification is going to lead you to the promised land and you'll have no sleepless nights. But the facts are that that approach can lead to some pretty extreme losses during severe bear markets. This is a chart of the S&P 500. Now, I know that a diversified portfolio won't move exactly like this, but when markets get to where everything has to be sold, all of the correlations go to basically one. Everything goes down, because when you have to sell something to meet a margin call, it doesn't matter what you own, you have to sell it. And if this happens as you approach retirement, it could really lay to waste some plans that you've made your entire life. For example, here's the 13 bear markets going back to 1968. The severe ones, on average, down 44.5%. This I closed January to July, but we're now down 19% again. So in danger of reopening the duration of this bear market, and just correcting from this 24.5%, you have to get 32.5% back to get even. If you do the average 44.5%, you need 80% back. Are you going to have the confidence to stay in the market when you're starting to draw on your nest egg? How about compounding from a much higher capital base because you never got into this situation in the first place? Our approach is down 9% year to date. The S&P 500 is down 19%. We are defensive because of the actions we take. I had somebody call any client that follows this dumb, and anybody that hires an advisor that follows this dumber on Twitter today. My reply was, you should start on your apology letter to your clients when you lose a third or more of their money, because it's going to happen during the next bear market if you don't have a sell strategy. And here's our approach. It's pretty simple. When the markets and the trend across the short term, that's the green line. The medium term, that's the red line. The long term, that's the black line. When we're trending higher above that, we are as long and participating in the gains as we can be. When things start to turn over or roll sideways, we get a little bit more defensive. If they really start to roll over and the slope of the lines trends lower, and if you break below this black line, the 200-day moving average, that's when the market is plain and simple risky. It's just a historical, mathematical fact. All of the big bad bear markets happen below this black line. So when we're below there, we are extremely defensive with not only our money, but our clients' money. Every penny of my family and Dan's family money, we're the partners. We're in the exact same strategy as every one of our clients. The gains, the losses, everything. It's exactly the same. We get the same prices at the same time of everything that we buy that our clients does. That's how confident we are in this approach. So things start to roll over. We're out of the way of all this because we're under the 200-day moving average and we've broken below all of the other lines. Now we've got numerous short-term signals to have us get back in. And when the market starts to trend higher, those include horizontal support, meaning the market undercuts a level and goes back above it. It's a very low risk entry. And then if you get above the short-term and medium-term moving averages, you can add more. This is what we did during this most recent run-up, and then we ran right into this declining 200-day moving average, and we started getting defensive again because we started to roll over again. Now today we undercut and reclaimed this 38.25 area that had been support for the last couple of days. We took a couple of low-risk entries in there. As the market looked like it wanted to rally, it then pulled back and rallied more into the close. Let's take a look at a 5-minute chart of the S&P 500. Here's your gap down. Early on, we held yesterday's lows. Everything was okay. Then we started rallying. Look, this intraday cup and handle was our signal to start taking a couple of positions. We were watching Apple massively outperform, and we're watching Tesla outperform, and we're watching ENVX outperform. We bought QLD, which is a QQQ proxy. In fact, let's bring up the NASDAQ 100 right now. You can see the same pattern. In fact, it was actually because of the outperformance of Tesla and Apple today, it was the breakout was prior to when the S&P 500 broke out. But here's the equivalent time frame. We ran into the highs of yesterday, which were near the lows of 4 days ago. That was resistance, and then we rolled over. So gave back some of the gains there. In fact, gave back all the gains and were negative. But we did this undercut. There's a key area here that we've been focused on right here. It's a big Fibonacci level. It's the 50% retracement level of the NASDAQ 100 from the COVID move. And we've undercut it and reclaimed it last Friday. We did it on Monday, and we did it again today. If this level gives way, especially if the lows of Monday give way, the market, I think, is headed for another leg down. But right now, we undercut it and we held. So we had a false breakout here, false breakdown here, rallied off that low. That's what was responsible for our 0.2 of a loss today, 0.2% loss, a little bit of a fade into the close. So that explains why we did what we did today. And if you'll notice, there was relative strength on the NASDAQ 100 because it did not undercut. Although it undercut that fib and reclaimed it, it did not undercut the lows of Monday or Tuesday, while the S&P 500 did. And primarily the outperformance in Apple and in Tesla are what is responsible for that. Those have been on our focus list for over a week here. Tesla and Apple. Apple not holding up as a leader, but you can gauge the overall trend of the NASDAQ 100 by what's going on with Apple. And if it's doing well, the market just is not going to collapse, is the way I'm reading it. So that's what we do. We follow the trend. If you're interested in this approach, reach out to us. We've added a ton of new clients over the last, literally, if you add up their weight, it's several tons of new clients over the last couple of months. So email me. I'd love to discuss it with you. Don@RevereAsset.com or Dan@RevereAsset.com if you want to talk to CFA and Revere President Dan Stewart, who will explain to you why he's a CFA and he recognizes that this is the best approach. As I said, we've got all our family money in this approach. So email any of us, or you can call 855-REAL-WEALTH. That's 855-732-5932. So there's the S&P 500 with the undercut and reclaim, false breakdown. We showed the NASDAQ 100. Let's show the Dow Jones Industrial Average. Also undercut the prior lows and reclaimed it, so a false breakdown there of the most recent lows as well. Let's go to mid caps. Mid caps, the lows pretty much held inside day, lower volatility on mid caps and small caps today as we're waiting for the big FOMC announcement tomorrow. Not necessarily the announcement, it's pretty much a foregone conclusion that they're going to raise by 0.75%. It's the reaction to that and the tone of their statement, and then Jerome Powell's press conference after that. So it's the reaction to that that will be gauging tomorrow more than the number itself. What's happened the last four is that we have rallied into the close on each of the four, and in some of the cases we gave it back the next day, so we'll be gauging the reaction. He couldn't really have been much more bearish than he was in his Jackson Hole speech. I should say hawkish, which means his approach to the monetary policy made the market get bearish, as we've had the gap down on 913 after his speech, and then another gap down on 915. Actually, his was 826 right here, the Jackson Hole speech, and then the big gap down with the poor CPI numbers last week on 913, sorry. So that's what we're watching, and we've had 4 out of 6 days down since that big reversal pre-market when the CPI numbers came out. So that's the indexes. Let's go to the tail of the tape here. Still have this stochastic and the indexes in a bearish technical setup. We're operating under the bear case. VIX spiked 5.4% today, above 27. So that 24 to 26 is kind of the neutral area. When you're above 26, fear is picking up. Fear and greed at a 37. Put call neutral at around 0.97. Big news out of Germany pre-market. Look at these numbers. I can't imagine what the reaction here would be. Up 7.9% month over month. 45.8% annually increase in their producer inflation index. Unbelievable. And that's mostly due to a poor energy policy. So this whole green energy zealotry that the leaders of Europe, the chickens are coming home to roost there for some very poor policies, not protecting their energy, the energy that's needed to provide to heat and cool their country. So we went from yesterday, day one, up to a down day today. That's 4 out of the last 6. Reminder about FOMC, as I mentioned. My expectations coming in today were negative to neutral after hitting support, as I mentioned, bi-directional trend day today. False breakdown, false breakout. S&P was between the support and resistance levels all day. This 38.15 is big. We haven't touched it yet. Here's the level that we've undercut 3 days in a row, but reclaimed by the end of the day. Reminder, the more you bang on a support level, the weaker it gets. So if it gives way in a big way, one of these times we will be adding on the short side and getting rid of our longs. You can see the ranges, the overnight range. We ran into this 38.15. We ran into 39.20 level here. We ran into this overnight and failed badly and opened all the way down at 38.67. So an overnight rally fizzled as we approached the market close. The dollar was strong today. As you know, that's not good for stocks. Ag stocks were good today. 11 out of 11 S&P sectors were down, including gold, base metals, uranium, and solar. These had been 2 leaders. They got hit today, 2 leading sectors. Retail weak, XLRE on the weak side, OIH, that's oil services, on the weak side. You can't even hide in utilities, which is a defensive sector. Look at this move down over the last 6 days from 78 to 74. Pretty harsh move down in what's considered a defensive sector. Here's our focus list. This is what we've been focusing on. Our buys today: Tesla, ENVX, and QLD. Let's take a look at the charts of the 2 that we bought. Here's Tesla. This was strong all day. Here's what we're focusing on: the relative strength. I've been talking about it 2.5 weeks now. Of course, it did fail on its breakout. Better buy would have been back closer to the 300 level, but with the positive reversal today, we took a small position in it, and we'll add to it if it continues to work or if it pulls back slightly. ENVX, this is a volatile one. Only sized at 2%. If you take a look at a 5-minute chart here, here's the breakout that we bought. It trended higher and then faded along with the market before going sideways to up into the close. And then the QLD, QQQ inside day today, and the relative strength that Tesla and Apple were showing. Let's bring up Apple. This was the strongest of the big stocks today, but it did run into and fail at the 21-day exponential moving average. And this could actually be a low risk short at this level, or with the relative strength that it showed over the last 2 days after relative weakness the prior days. There's really been a big battle going on in Apple between the bulls and the bears. We're going to see which way this resolves. Best case scenario, you get back above this 161 level, will put you above all the moving averages, and then you can challenge the most recent high here from the big gap up the day before CPI. So those are the really the only charts we're going to take a look at today. Well, how about a couple more? Let's look at the dollar UUP, since this has been so critical to the weakness in the overall market. You can see false breakdown in the dollar last week from failed moves come fast moves in the opposite direction as it heads toward new highs. And look at the 10-year here, TNX. Just a frozen rope higher along the 8 EMA, and then a gap up today. Almost gapping out of the top of this this range. If you were to draw a trend line higher, we'll see how this resolves tomorrow. But right now, the 10-year extremely extended. Let's bring up the 30-year. That's 0TYX on MarketSmith. Same situation, not quite as big a gap up today on it, but that's because the yield curve is getting more and more inflated, with the bottom end of the curve rates rising higher than the long end of the curve, the short end quicker than the long end. Let's see what else we need to focus on here. So bottom line, bidirectional false moves waiting on the FOMC tomorrow. Same levels of support and resistance, nothing changed there. That we're looking at tomorrow overhead. You've got this 38.87 to 39.20, the first resistance level, and then down below that 38.13 to 38.15, and inside here is that fib level, the 286.82. Those are the key levels that we'll be focused on tomorrow. See what happens pre-FOMC, and then we'll have the algo volatility as we always do after that. That's going to wrap it. As always, love to hear from you. Don at RevereAsset.com. 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make in the market, it's how much you can keep. Sequence of returns is incredibly critical in the few years before you enter retirement. You can't afford to take a big hit to your portfolio. That's why risk management is job number one here at Revere. You take care of the risk, and the returns will take care of themselves. Wrapping up Tuesday, September 20th, this is Don Vandenbord with Just the Facts. Thanks for listening, and have a great day.